Is the stock market going to crash in 2018? In my humble opinion, no, it's not. And anybody who tells you that they know which way the market is going to go is probably delusional, okay? It's not possible to forecast what's going to happen in the stock market. Guys, welcome to the Independent Investor Channel. We're coming to you from New York City. New York, my name is Ryan. It's good to be with you guys. I was hit with this question by one of my subscribers, and the question was from Lavertus. So this is for you, man. I'm making this video directly for you, but also I thought your question really struck at a nerve, and I think a lot in the viewing community can benefit from this. And the root of the question was, with all these new investors getting excited about investing in the stock market, how do we position ourselves, or how do we prepare for an eventual stock market crash? Okay, that was the root of the question. And I think it's very, very safe to understand these few premises about stock market investing. Markets go up and markets go down. You want to buy low and you want to sell high. All these cliches, they're all true. And it's really, really easy to get people excited about the stock market when the stock market is doing what it's doing now. What's really, really difficult is to get people to invest when the stock market is really, really bad. It's a conversely, opposing relationship, right? The best time to invest is when everybody's kind of running for the hills. But that doesn't mean that young people now, or people who are looking to get exposure for the first time in the stock market now, can't participate in the stock market at any time, okay? But there's some very, very strategic ways of entering the market, and I just kind of want to talk about those on this particular video. The first thing is when you're coming to me and you're asking about, is the stock market going to crash? Okay, in my opinion, no. A crash is a total demolishment of the market. It's financial institutions go default. It's finances or banks close down, right? And everybody starts rushing on the banks. It creates a panic. A crash in the financial sense is really, really bad. Now, when we're talking about a recession or a prolonged stimulus in the market that has driven the economy down by all indicators that are used to track the market, I'm not going to get too technical, but a recession is a prolonged systemic problem in the market. And recessions, believe it or not, are actually normal in the stock market, all right? We've had 44, I believe, in the history of the Dow Jones Industrial Average, to where we've gone into what's considered recessionary period. And the critical thing to remember is the long-term approach, and that each one of those 44 episodes of a downturn or a recession provided very unique buying opportunities for investors if they had just either been invested and stayed long or used it as an opportunity to buy stock. All right. What I think is the most anticipated event that could happen within the short to medium term here with the stock market is perhaps maybe a correction. And a correction is basically just a rubber band effect, okay? This market has run up really, really fast, and it may correct back. And there's a lot of different things that can affect a correction. Sector rotation is the biggest one, where fund managers will take profit off the table when they're recording their annual profits. They'll take from a hot sector like technology, and they will transfer those dollars over to, let's say, a less beloved sector, which is telecom right now. It's been beat up all year. But those sector rotations are actually quite normal. What does this all mean for you guys? The root of the question was, what do we do now if we're investing dollars into the stock market? How do we play this thing? And we'll get to that. There are phases to investing, and I'm going to come out with a solo video on phases of investing, okay? But for this particular takeaway, what I want you guys to understand is the first phase is budget and saving cash, That's the first phase. It's looking at your inflows and outflows. And I've done videos on all this to kind of assist you guys on helping you identify maybe 100, 150, 200, and whatever it is in your particular budget that you may be potentially willing to identify, cut that expenditure out, and you're bringing that money basically back in to help you save that nest egg. Now, the intermediate stage is where you actually start your investing account, which is the self-directed Roth IRA. You start to fund that account and you actually start to invest passively and long-term. Now, what a lot of people don't understand is they want to jump right to phase 2 without going through phase 1. Now, if you're in phase 2 and phase 3, you are never going to relinquish your responsibility in the prior 2 stages when you get to the advanced stage of investing, which is investing and trading, okay? You're never going to relinquish stage 1, your budgeting. It doesn't mean that because you're an investor, you can go buy a Lamborghini over here. It doesn't mean that. It means that you're starting those disciplines early and you're starting those cash reserves and you're continually build those cash reserves up here in phase 1 as you move to stage 2. You don't relinquish stage 1 and then to stage 3. But I think a lot of people, man, they want to just jump right into the stock market. And in regard to Laverta's question, to me, my question back was, are you prepared to enter the market? Okay? Do you have a good cash reserves to where you can take a certain percentage of those tax reserves and devote those to an investment account, right? And that doesn't mean that you take all of your money, 100%, and you put it all into the stock market. That's not what it means. We take a systematic, calculated approach to entering the market. That's what I mean. Identifying what you have. Let's say you have a nest egg of $2,000, right? Take 500 of that and put it into the market. That's 25%. That's calculated. What most people do is they want to save $2,000 for investing, and when they hit that 2,000 goal, they want to dump it all in the stock market, and they don't leave themselves 2 pennies to rub together over here in phase 1. Okay, guys? Another defensive technique that I'll use, and I say all the time when the stock market is doing what it's doing right now, I spend a lot more time watching the stock market, but the second that it turns negative, I'll go back to this particular goal right here. I've been strategically positioning my portfolio all year in 2017 because I've kind of got this wrong. I've kind of said that we've been waiting for a little bit of a bigger correction that just has not come. And we have nothing but positive stimulus on the horizon with regard to tax cuts. If this thing goes through, we've got some regulatory rollbacks, and through the tax cuts, we've got corporate repatriation coming in. Those are all positives. Not to mention, we've got a holiday season where consumers are spending like crazy. We have an economy that's booming since the new president took office last November. We have earnings that are killing it. The earnings reports have been high, and interest rates historically are low. So all those things are really promoting this market, and it's creating an environment that is conducive for stocks to continue to grow. So for new investors, if you're entering the market, set a target date. Set a target date. If you're 20 years old, you've got 40 years to invest. 40. So why are you worried about 2018 if your target date is 40 years down the line, right? Another technique that I'll use on this invest long term is when the market starts getting cranky, turn it off. Turn it off. Turn it off. If it helps you, turn me off. When the market goes down, I'm actually going to still be doing YouTube videos. I'll just be talking about how we deal with the downturn and what the current state of the market is. Why? Because it's interesting, but it doesn't really speak to your long-term passive approach. It doesn't, especially for those investors in phase 1 and investors in stage 2, all right? If you're in the intermediate stage of investing, it shouldn't really matter what the stock market does in 2018, all right? And just a final kind of rule of thumb, really, to kind of drive home the point for Laverta. One of my most devoted subscribers. So hopefully they don't mind me calling them out on the Independent Investor channel. I really appreciate the engagement that I have with this group of folks, man. They're awesome, very loyal subscribers, and I hope they don't mind me calling them out. I hopefully they don't, but I'm going to do it anyway because I love them. But this really is good for all you guys. And the rule of thumb that I abide by all the time is to think about the stock market in this regard. If you're in phase one and you have X amount of dollars built up, let's say 5,000 or 10,000, it doesn't matter. If you took whatever percentage out of those dollars to devote to the stock market, could you sleep easy if tomorrow that amount was cut in half? Okay, cut in half. So now you sit back and you're like, okay, whoa, Ryan, hold on a second, I'd lose money. The chances of that happening are relatively slim, but you guys have to understand that investing involves risk. It involves risk, okay? The stocks that I recommend to you guys are just my opinion. You guys, if you want to read my detailed disclosure at the bottom of every single one of my videos, it speaks in-depthly about this being more of an entertainment channel. It's a testimonial. Now, I tell you what I specifically do, so it makes the testimonial easy, but investing involves risk, all right? So how do we deal with a stock market at its all-time high? Sit back for a second and don't get so caught up in all the excitement about the stock market and people making all kinds of money right now. None of that means anything for you, all right? If you're looking at $5,000 nest egg and you're saying, you know what, out of that $5,000, I want to take $1,500. Why? Because if I invested that $1,500 on Monday morning and the stock market just so happened to crash, right? I would be comfortable with having that remaining $3,500 safe and sound in my liquid savings account, and that $1,500, if it goes down to $750, then I'm abiding by the rule of thumb because I can sleep easy at night, all right? Then you're going to come to me and say, why'd you get me invested? And you know what I'm going to say? I'm going to say, now's the time to invest over here. Guys, thank you so much for tuning in to the Independent Investor channel. This is kind of my address from my perspective on a potential stock market crash, 2018. Guys, stay the course. Stay the course. Investing correctly has a lot to do with long-term passive investing. I say all the time, investing correctly is boring in nature, and a lot of people throw shots over the bow and talk about how boring the anemic rate of return per year. Yeah, but it's correct and it's proven over history. If this is your first time viewing the channel, guys, I highly encourage you to subscribe to the channel. Hit the notification bell, man. You'll be notified of any future videos that I post to YouTube. They're very informative. We talk about stocks, real estate, and selling your house for sale by owner. Leave your comments at the bottom. If you guys have a different twist or a different idea about what you think the market's going to do in 2018, I'd love to strike up a commentary with you guys in the comments section within my community, and especially within my subscriber community, about what you guys think the current direction of the market is. Let me know what your thoughts are on the video, and if you guys have topics for me to address on future videos, that's a perfect place to do it. Guys, thank you again for tuning in, and good luck in your investment future.